want to welcome a very special guest, Brad Powell. Brad Powell is a very good trader. He's been working in the industry for 20 years. He's also very fun to work with, and I'd like to kind of introduce him to you today. So with that being said, let me go ahead and drop this here. And we'll go ahead and let Brad get started.
I want to thank Jeff and all the people at MetaStock for having me. They are just truly a great group of people to work with. Very genuine people who care a lot and really enjoy the platform and enjoy working with them. There are difficult people to work with in this industry, and they are the easy and good ones. So I always kind of start, anytime I do a webinar, just saying, obviously I'm here to promote right angle trading in our products, but what I really hope is that, this is some beneficial, useful information from this presentation for everybody. I always say, my trading methodology or our company's trading methodology, or Betty, who's the founder of Right Angle Trading, her methodology isn't necessarily right for everybody. We talk a lot about in our courses about finding yourself as a trader and knowing who you are as a trader. So regardless of that, if our methodology may not be right for you, whether it is or isn't, hopefully there's some beneficial information contained in today's presentation for you. And the first 10 or 15 minutes, I'm going to do kind of an overview of ETFs and what they are and where they're traded and just some things that we look for in them. And some of you may be very familiar with the ETFs and with the ETF market. I'm constantly amazed when I do these webinars at people who really don't know anything about them and ask questions like, well, what kind of broker do you need to trade an ETF, or where are they traded, and that kind of don't understand some of the basic principles, especially with the introduction of leveraged ETFs over the last few years, because they are still relatively new, just 4 years ago that they were introduced, that the SEC allowed it, but we'll get to that in a second. Anyway, I'll give you a quick little background on our company. The company was founded in 2003 by Betty Crow. She's a former executive vice president, financial advisor at a large Canadian brokerage firm. She's a 28-year market veteran and just adamant about technical analysis. She studied with George Lane, who developed the stochastic, one of our key indicators that we use, all the very different settings than kind of our proprietary settings, very different than what he had. Horace Mueller, who founded the Canadian Technical Society of Canadian Technical Analysts, very well-respected market technician, and many others. We're always asked, okay, why do we do this? The first question I ask anybody, why do you do it? And kind of the pat answer is, oh, well, we like helping people. I'll tell you the truth. I started day trading full-time in 2001. I've been in the market since I was about 13 years old. I grew up in a family of stockbrokers and started trading my own account when I was about 13. Betty had just launched kind of what is now the largest hedge fund, did the IPO for what is now the largest hedge fund in Canada, or one of the largest, and broke her shoulder and her knee. So she was laid up at home and got lonely. And I traded for many years just alone, and I find I'm a very outgoing type A personality, and I just nearly went insane because we spend so much time in a stressful environment in front of a computer monitor. So the main reason I do this is I enjoy meeting people and working with other people and having the interaction. We have a lot of fun in our live trading days. I love doing webinars. And Betty is very much the same way. And that's kind of why we hit it off, and I joined the company in 2006. So the company's first futures trading program was launched in 2003. That was updated in 05, 8, and 11. Really kind of a major overhaul in 2011. We have an automated future system that was launched in 2009 that currently runs at several brokers. Our first ETF product was actually launched in 2008, and to Betty's credit, she was one of the first people that I met or that I talked to who took one look at the leveraged ETFs when they were introduced and said, this is just going to be huge. This is going to be a huge part of the market going forward. And then we started our end-of-day ETF service later in 2008 and came out with a comprehensive guide and ETF trading manual, which was launched in 2010, and a strategy specifically for ETFs. For some of you, this is going to be kind of old information. You know this. Others still aren't that familiar with exchange-traded funds. It's an investment fund traded on a stock exchange as tracking stock for an index, sector, commodity, currency, bond. You name it, there's basically an ETF for it nowadays. An ETF's valuation, so it's basically, it trades on a stock market. Most of them trade on the Amex for various reasons, which I'll get to in a minute. The ETF's valuation is based on a combination of their net asset value, meaning their holdings within the fund, and market fluctuations based on simple supply and demand, just as a stock. Index funds were originally launched in 1993 as the index tracking stocks, which were called SPDRs, and that's the SPY for the S&P 500, the Diamond for the Dow, and the Qs for the NASDAQ 100. Those were the first three. In 2008 is where the big change in the ETF market came, because the SEC approved active management for ETFs, which allows leverage through derivatives, so futures, options, and bonds. Today, there are currently over 1,400 ETFs and ETNs, what are called ETF or ET products, exchange traded products. The difference between an ETF and an ETN is the ETF gains leverage and takes holdings through actual stocks in the sector, futures and options, whereas ETNs are in senior secured debt, so basically in bonds. ETFs currently represent about 35% of daily market volume, and that is gradually rising. So that's a huge percentage of the daily volume, which is in ETFs. Many of them trade on the American Stock Exchange. One of the main reasons is they don't want these ETFs, because so many of them trade such heavy volume now, to impact things like the tick or the trend that are based on the New York Stock Exchange readings. Some of the traditional technical indicators that are affected just by the number of stocks upticking or downticking or volume or options. Those kind of technical indicators, they don't want them impacting the underlying index that they may be tracking. Some of the advantages of ETFs, based on how we look at them, is they give you an exposure to a broad range of indexes, sectors, and commodities. So you're not limited anymore to just SPY. You could take a position in a Chinese market, in gold, in bonds, in currencies, all through the ETFs themselves. So it really opens up to the individual and smaller investor kind of some areas of the market that weren't readily available to them 10 years ago. It allows you to have a range of leverage, meaning anywhere from unleveraged to now, for example, the RTSA, which is a short index for the Russell 2000, which runs at about, I think, 7 times leverage. Range of leverage allowing investors to select a product based on your individual risk tolerance and obviously your profit goals. ETFs carry with them the stability of an index that won't be as affected by news as individual stocks can be, which is a positive. Obviously, broad economic news has a major impact on them, and they'll track the index or sector or whatever they're tracking. But you're not going to have a 20% overnight gap because of an earnings warning or something like that. ETFs cannot be halted, unlike individual stocks. Inverse ETFs, really the biggest advantage, allow short exposure in retirement accounts because you go long the inverse ETF. So, we're saying we're always going long something even when we're shorting. We never actually take a short position, which opens the door to IRAs and RRSPs and accounts like that. They are highly liquid with very consistent volume for the most part, or at least the big ones and the ones that we like to trade. And there's relatively low costs associated with trading ETFs on commissions and platforms, especially compared to futures. I actively trade futures intraday, and I'm also trading ETFs in my IRA. But, futures are kind of expensive to trade by the time you add in commissions, $3.80 per round trip, $4 per round trip per contract. If you're trading multiple contracts compared to an ETF that you can buy $100,000 worth of an ETF for a flat $7 fee and still get the type of leverage to give you a pretty decent return even on an intraday day trade. Some of the disadvantages of ETFs, and I'll get to, we'll look at some specific chart pictures here in a second. They can have very large opening gaps in leveraged ETFs, and that can really kind of throw off the trading in them. And we'll look at some examples of that in just a minute. But an example is from October of 2011 through February 2012, the S&P 500 rose 12%, and of that 12% rise, 8.6% was contained in the opening gap. So that suggests there was very little follow-through during regular market hours, which then limits your trading opportunities. And if you're on the wrong side of a trade, you can get trapped or stopped due to the gap. So especially in the triple leveraged ETFs, you can have these very large gaps. Inverse or short ETFs have no bottom, meaning you could buy an inverse short ETF at $50 and it could go all the way down to $5. Let's say you bought 100 shares. They decide to do a 1-for-10 reverse split on it. Now you have 10 shares back at $50 again, and it goes down to $5 again, and now they do another reverse split. So just remember, and actually it's true of long ETFs too, in theory. There were some in the leveraged ETFs, some like the for the financial sector, which we'll be looking at in a minute. There were some real problems with the leverage in the first year they were introduced, as they kind of figured out where to gain this leverage and how to avoid just everything going down. They both, the FAS and FAZ, both opened at $200 a share and both went to $20 a share, which didn't make a lot of sense over the next year and a half. But in particular, short ETFs have no bottom, so you can't say, wow, it sure is cheap here, because they'll just make it more expensive the next day after a 10-for-1 reverse split, which happens frequently. The other issue with some ETFs is they may not properly track the underlying index sector or commodity due to supply and demand in the open market, or the derivatives that they choose to gain leverage. And we're going to look at a specific example of that got a lot of press a couple of months ago. And there may be decay over time based on the derivatives they're using for the leverage. And we're rarely in an ETF for longer than 6 weeks. We don't look at leveraged ETFs unless you're playing the SPY or the diamonds or the Qs, which are unleveraged and perfectly track the indexes. But as far as the leveraged ETFs, they're going to have decay over time as the premiums on the options used or the other derivatives to gain leverage decay. And we'll look at some examples of that. So one of the more publicized issues with some of the ETFs, and there's been several that have had this issue, but is the natural gas ETFs, which got a lot of negative press not too long ago. And up top in green, we have natural gas futures, and this is over about a 9-month period. And down below, we have the UNG, which is an unleveraged natural gas ETF. But they still had to, just to track the price of natural gas, had to buy something that they thought was going to track. So what they ended up doing, and what we're looking at here, I think, is back in March, April, May of 2012, they had gone out to distant summer options on futures. And those options had a very steep premium, and such a steep premium that they actually decayed dramatically, even though the price of natural gas was rising. So the price of natural gas rose 30%, and during that time, there was a 10% decline in the price of the UNG, which should have been tracking the price of natural gas. And instead, as you can see, even after that, when it flatlined, because they had paid so much premium on these options on futures, it just went straight down. So once they got out of those, it actually ended up having, over a period of time, about a 70% decline versus a flat line in the price of natural gas over a 9-month period. Once they got out of those, they restructured the way, and you can see over the last couple of months, this is probably the last 2 months, it is pretty well tracked, the price of natural gas. So something we suggest doing, if you're going to trade a commodity ETF or use a commodity ETF as an investment instrument, longer-term investment instrument, put up a chart, spend some time comparing the ETF itself to the underlying commodity. The same is true of bonds or currencies, and make sure that over a long period of time, over at least a year, it's really tracking. And to show you an example of one that tracks well is the S&P 500. So I happen to find a point on a percentage basis that they were all dead even, and that point was, I don't know, a year and a half ago or something. And so the SSO is in red, the SPY is in yellow, and the S&P 500 cash index, INX, is actually in green. And as you can see, the SPY just lays perfectly right on top of the S&P 500 itself. It might be off by a penny or two just based on the bid-ask where it closes at 4 o'clock Eastern. And the SSO does a very good job of tracking it. And you can go to any point in time and you will be within 1% of twice the return of the S&P 500. So if the S&P 500 is up 10%, it'll be somewhere between 19 and 21%. So that's an extremely well-managed ETF as far as tracking its underlying index. And all of the major U.S. index ETFs are really good about this. There are some odd variations that happen at certain times of the year with the Russell or even with the SPY when it trades post-dividend, because some of the ETFs do pay dividends, and so when they trade post-div, it may have a significant drop in comparison to the index. Of course, you're getting that back via the dividend. The Russell 2000 can be a little odd at Russell rebalancing in June because they drop 50 or 60 stocks, sometimes 200 out of that 2,000, and replace them with higher value stocks. So the Russell 2000 leverage ETFs can jump up much more than the index itself, as they're suddenly in when the index itself, the 2000 has higher value. So that's something to be aware of. One of the other disadvantages that we talked about were gaps. And this can especially be true if you're looking for an ETF to trade. So when we're looking for ETFs to day trade or to trade on a short-term swing basis, meaning off something like hourly charts that we're going to take a position and maybe hold for a day or two, you want to be wary of gaps. And so we're always looking at the gaps. And I'm using the EWH, which is the Hong Kong Index Bull ETF, just unleveraged bull ETF as an example. The reason I'm using this one as an example is, like many of the overseas markets, the ETFs for those markets are going to be trading while we're asleep, while the U.S. markets are closed. So they're going to be heavily impacted by gaps overnight. Same can be true of U.S. bond ETFs, because there can be huge fluctuations in the dollar overnight based on what's happening overseas in Japan, in China, and Europe that impacted at the open. We don't really particularly like. We talk about them in our trading course. Some people, we have clients who trade them. We're not huge fans of the bond ETFs. We do like the emerging markets because a lot of their price movement intraday corresponds with the U.S. markets because they're heavy in the Latin American markets that are, Brazil, Argentina, that are open at the same time as the U.S. markets. But if you look at the China ETF, you can see on this particular day that I marked, there's a 1.1% gap, and then it had a 1.1% intraday trading range. So you can look at that and say, well, there was a 2.2% trading range for the day, which in a leveraged ETF would be 6.6% if you're looking at a triple leveraged ETF for it. And that's a pretty good trading range, and you can catch some good day trades on it. But because half of that move is in the gap, in a leveraged ETF, that only allows you 2 to 3% intraday trading range, which is really not enough to go after day trades with. It's just not going to produce enough return even with the leverage. And, I just happen to pick from this particular day out 2 days on my chart. There are other days where, if you look here, 75% of the move is in the gap, and you're only left with less than 1% intraday price trading range, which even in a triple leveraged ETF is going to give you less than 3% intraday range. So it may look like on paper, wow, this thing moves 7 or 8% in a day. Again, a triple leveraged ETF, or the underlying unleveraged may move 3 or 4% in a day even. But if 75% of that move is in the gap, you're not left with much to trade intraday. So another thing we recommend to people, and again, whether you're trading our methodology or somebody else's methodology or your own methodology, before you go to day trade an ETF on an intraday basis or a short-term swing, where you're just holding for a couple of days, look at how big the gaps are. Look at it over the course of a year and compare the opening gap to the actual intraday price movement. And unless a leveraged ETF is giving us, say, 5%, it would kind of be our bare bones minimum, 5% intraday on a regular basis, we don't really find that it's worth trading on an intraday basis. You just don't have enough left to trade there. So those are just a few tips and a few things that we look at in ETFs and a few of the disadvantages. But the important thing, and we always say nothing beats chart time, is just put up some simple charts of the ETFs, its underlying index, look for the gaps, compare it to the index or commodity or whatever is underneath it, whatever it's supposed to track. Make sure they're doing it, that the people who are actively managing the ETF are doing their jobs properly, because they all aren't, and that's the bottom line. Sometimes they're going to choose the wrong derivatives. So our criteria for selecting ETFs to trade: intraday, we want to see high liquidity. We look for a minimum. They need to trade at least $1 million. Obviously, something like the SPY trades 100 million, but we're not going to trade the SPY intraday. We're looking for triple leverage intraday trading, or double leverage in the case of oil. So we want to see at least 1 million shares a day being traded, because we don't want to pick up slippage, and we want to make sure we're getting filled with our size. We want to see consistent volume. So, for instance, the agriculture ETFs jumped up in volume when this drought started. I'm in Los Angeles. We're a very virtual company. Betty's in Canada. We have another person in Canada. We have a person in Phoenix. I'm in Los Angeles. We finally got hit by the heat wave the rest of the country has had this week. It's just blistering here. So I feel for anybody in the Midwest. But as we know, this horrible drought in the Midwest and in the farmland, the corn ETF doubled in a couple of weeks. They were suddenly trading 600, 700,000 shares a day, but that isn't the norm for them. It was only because of weather conditions in this particular summer. Prior to that, they were only trading 25,000 shares a day, which is fine if you want to do a longer term investment, but not if you're day trading, because that volume is going to dry up. Once it's out of play, once the crops are done, the volume is going to dry up and it's going to go right back to 25,000 a day. Consistent intraday price movement, as we looked at on the EWH, not all in gaps. We are primarily trading with the prevailing trend, and that may be a very short-term, a 3-hour trend on an intraday basis. So we want something that trends pretty well, and that takes me back to the bonds. On an intraday basis, bonds actually don't trend that well. It's fine if you want to invest longer term in bond ETFs, but because so much can happen in the gap, they tend not to trend real well on an intraday basis consistently, and especially when we're in an economic environment like the one we're in now, where interest rates aren't moving. So the bonds just aren't changing that dramatically. For swing trading, again, we want high liquidity, consistent volume, and we typically look for things that we want to avoid excessive overnight gaps, which isn't always possible, especially in triple leveraged ETFs. But as we saw in the EWH, something that isn't going to be so heavily impacted. I think the only thing we really trade that may have this huge overnight gap based on what's happened overseas is the emerging markets. Our ETF methodology is, as I said, we're primarily trading with the prevailing trend. We think that's a good way to trade ETFs. They trend very well because of the leverage. You don't want to risk whipsaws. So we think sticking to some methodology that prevents you with trend trades is really the best way to trade them, and especially because we're never going to be, even for our end of day stuff, we're never going to be in anything for longer than 6 weeks, and on an intraday basis, it's somewhere between 30 minutes and 2 hours. We're looking for a reward to risk ratio of at least 2 to 1. We want to reduce risk as quickly as possible via stop adjustments. And that's because of the leverage that we're using. And again, that goes back to when you're with the trend, you can see pretty quickly if it's going to keep going your direction. And that allows you to move your stop a little more quickly. We're going to practice money management with risk reduction as well as trailing stop. So exiting a portion of our position on an intraday basis and then trailing it when you catch a strong trend day that we'll look at in a minute. And, we like trading styles that are going to adapt to the individual trader's time and availability. I'm a full-time trader, so I'm trading futures all day, and so it's very easy for me to have 4 ETFs that I'm watching and throw a trade in my IRA on one and, still be trading futures. Not everybody has that luxury. Some people may be working. I know we have a client, very long-time client, who comes to all of our live trading days who's a doctor. And so he kind of pops in and out. He's a radiologist, so he tends to have a lot of free time during the day, or he can make time where he's studying X-rays and whatnot, and can kind of watch the market. I'll avoid making any jokes about that. I wouldn't want him looking at my X-rays because I know he's watching the market. But he can pop off, one or two or three intraday trades a day if he wants to. So that's kind of important. And then trading styles and time frames that will adapt to any market conditions. So we're looking at a broad range of time frames, or monitoring a broad range of time frames, which is important in ETFs because the market changes. And if you look at, fairly recent market, so we're just looking at the S&P 500 for the last 6 months. And during this time, other than a little poke here and a couple of little pokes down here, for a 6-month period, we've really been in a 6% range. And if you shorten that up to, I remember there was a 3-month period here to here, what was it, like April, May, June, that we were in a less than a 5% range, the S&P 500. So I'm fond of saying there's always a trend in some time frame. You may have to go shorter, you may have to go longer to find it, but you can always find a trend in there somewhere. So even in a relatively stagnant market right now, we have this nice up channel working, and we've been catching some trades in and out of it. We do things for our end of day. We have an end of day ETF alert service that we're much more conservative with than what we teach in the ebook. And I have some clients who do both with us, and they email me and say, "Gosh, didn't we have a trade set up today?" And I say, "Yeah, well, we did as per the ebook, not necessarily on our end of day because these people aren't watching charts and can't trade actively." But we did catch a few trades, and then we just had a lose. It kind of broke a nice string of winners with a losing trade recently. But so we have this nice little trend working, but we may still be stuck in the range. I'm of the camp that we may be in a range-bound market through the election. We'll have to see if we can really break out over 1420 and try to pound up. I think we're going to probably stay in this channel for a while and be relatively range-bound. So that makes it a little more challenging to find good trade setups, right? So you have to look at a variety of time frames. And I wanted to show, as we teach in the ebook, gosh, I wish I had put a label on this. Okay, this is the QLD long daily. So during this same period of time where we're in kind of a range-bound market, on a short-term or on a daily basis, we caught a long signal here that we did have on our end of day alert, and we got out here, so that was a nice trade. I think it ended up returning 10 or 11%, and then you get a short signal that we're trailing down, but unfortunately we got into this choppy range-bound market, so a trailing stop gets hit, you end up not getting much out of it, and then we just kind of went a month without getting a signal. We got a nice long signal that went up. We exited, you get 5-6% out of some of these trades, or I'm sorry, a short signal, you get like 5% out of it. We get an exit signal rather quickly, then we get a long signal. We're out a few days later for 4 or 5%. So, we had via the ebook, we didn't issue it on our end of day, a short signal that immediately flipped you back into a long, and then a short, and we took a long, and then we did take a short, so we took a long, we took short, we're out a few days later, we reverse and go long, we're out a few days later, we catch a short that stopped out, but you're just kind of trading back and forth in this choppy trading range, and you're only really getting 3 or 4 or 5% by the time indicators flip. And I have on here 2 of our 5 indicators that we use. This is a stochastic with our custom inputs, and this is an indicator we use to really kind of recognize key pivot points in a trend in shorter time frames, and I just keep it on the longer time frames as well. And as you can see, we're weaving back and forth around what should kind of be a support level. It's very choppy trading. It's very range-bound trading. We may have a breakout happening now, or we may fall right back down into this range and stay in the channel. Who knows? I don't know yet. We'll just take it one day at a time. But even in these kind of choppy range-bound conditions, because of the double leverage in the QLD, over this period of time, you can end up generating 20 or 25% return in a period of time where really, if you look at the 6-month period, it's really right where it started, or just a couple of dollars higher than right where it started 6 months ago. So you're able to trade in and out using the leverage, and we like double leverage ETFs for end of day stuff because they kind of help protect you against a large gap and a triple leverage. We really like the triple leverage for intraday trading and double leverage for end of day and short-term swing trading. And then breaking it down into a 60-minute chart in a 1-month period of, we're looking at the UWM, we got 4 trade setups, 2 won and 2 lost. First trade lost, it's choppy market gapped against us, minus 3% of from where our stop would be. This is a double leveraged ETF. Set up a new long signal. The second trade gives you 13%, and then you come down and get a short that stops out for minus 2.5%, and then you get another short signal, and we get an exit signal for 7.5%. So in that same 1-month period, where off the dailies you maybe only make very small percentages as you're in this range, using a double leveraged ETF, you're able to generate, and of course I can only use our methodology as an example, but I'm sure there's other methodologies that do very well. You're able to get minus 5 to about 15% in that same 4-week period. So you go into a double leveraged ETF on this, you still are using the leverage to your advantage to get a return, pretty decent rate of return, and at the same time you're minimizing risk because you're in double leverage compared to a triple leverage. You don't carry as much overnight risk. You can use reasonable stop loss settings of 3 or 4% on the double leverage on a 60-minute time frame, and you're maintaining here a very nice, probably about a 3-to-1 ratio on your winners versus your losers, which is good. If you're trading at 3-to-1 on leveraged ETFs, if you trade at 60% or 70%, you're going to do great. Even at 50%, as we see in this time period example, because you're trading at a 3-to-1 profit-to-loss ratio, you're going to do okay, and leverage is going to work in your favor. And sample ETF returns, what we believe somebody should be able to do, and these are pretty conservative. I actually had a client of ours email me the other day, or a couple of weeks ago, and he was telling me about this great month he had trading 2 markets intraday, and he had done 60% on the TNA-TZA pair, which is the Russell 2000 triple leveraged ETFs in silver. And I'm like, wow, that's phenomenal. I mean, a 60% return on his IRA in a month. So what we believe you should be able to do using ETFs, and again, this is what I'm sitting and doing in my IRA as I'm day trading, futures to make my living, and trying to plan for my retirement trading ETFs. But you can also do this, Betty, who's the founder of Right Angle Trading, very actively is trading ETFs just for profit in day trading accounts. Canada's kind of nice up there because they don't have the same day trading minimums that we have here, which is $25,000 for more than 5 round trips in a week. I know clients who have smaller IRAs than that, broken up into 3 or 4 different IRAs, so they're kind of taking different trades in different accounts to avoid hitting the pattern day trading margin calls. But we believe, so on an intraday basis, choosing one triple leveraged ETF pair, averaging 2 trades a day, you can return 25% a month. Short-term swing trading, again, very conservatively, in a double leveraged ETF pair, you're going to get about 4 trades per month, conservatively do 10%, is a total monthly return of 35%, which is an annualized rate of return, non-compounded, of 420%. And if you're compounding, that's going to grow. Well, that's a phenomenal annualized rate of return, and that's using triple leverage for intraday and double leveraged for short-term swing. And then if you add on, some end-of-day trades over the course of the year, maybe doing another 30, 40, 50%, you can end up doing a really phenomenal annualized rate of return. I want to look at kind of what we do, and I'll show kind of more specifically. And we talk a lot about what we like to do intraday, and so looking at my MetaStock trading charts, These are 5-minute time frames. In our last webinar, we talked about, meaning our webinar to our clients, our trading webinar, about monitoring what's in play, because summer trading really just kind of flat out sucks, right? You don't get as much range, you don't have as much volume. The last 3 days, oh my God, have we hit the doldrums or what? It's like I'm falling asleep. I know Monday on the NQ, I had 5 trades, and then I didn't have a trade again until today, and I only had 2 today. I trade the NQ. So, I mean, it's like a ton of trades because we had a nice trend day on Monday, and then just nothing on Tuesday and Wednesday, just flatline chop. And I know yesterday was a terrible day on the ETFs like the TNA and TZA, but we're always monitoring the TNA and the TZA, the Russell 2000 triple leverage ETFs, the SPXU and UPRO, which is the SP 500 triple leverage, kind of our core bread and butter. And then I like to monitor 2 more, which are the right now. It'll vary based on what's in play. Well, commodities aren't known for doing much in summer, especially in August, other than potentially oil. So we're monitoring the UCO and SEO, which are double leveraged oil ETFs, and they've had some pretty good trades. And then, we've had the ECB announcements and the FOMC policy statement. So we know leading into that, and we know with all that's going on in Europe and the debt situation and bailouts, etc., that the dollar is going to be in play, that currencies are going to be in play. That's going to affect bonds. That's going to affect banks. So we go to the financial sector, which the triple leveraged FAS, FAZ, for the financial sector, the FAS is the long and the FAZ is the short. And these are great to trade when the financials are in play. They can also lay idle and kind of come in and out of play. So I want to look, I'm just going to really quickly, some of the things that we look for is we're looking for a trend to develop. And so this was on the 26th, July 26th. So we come into Friday the 27th, and we see that we have a trend going. And as I said in our previous webinar, training webinar, we told everybody, start monitoring the financials. They're going to be in play. And sure enough, Friday came in, we got what we call a trend day, which is kind of what we live for if you're trading trend continuation. We had a gap up, retraced, stayed right in line with this trend. We came down and we got kind of our very basic, simple trend continuation trade, which is, we call this a slingshot trade, which is with our proprietary settings on the stochastic. You get a much lower low as price is making a higher low. We want to see a price pivot kind of right around the screen area of the screen indicator to indicate that that's a high probability price pivot. We get this great setup and we go long at this candle at 88.72, and then we get an exit signal up here for a 1.3% gain. And then we get another signal in the same trend, and this will happen in a trend day. We're just trading in and out with the trend. We're going into lunch. We kind of gradually move our stop up. And we get a big breakout because of some rumor that came out of Europe that something wonderful was going to happen at the ECB meeting. And boom, this trade makes 2.8%. And then as the day goes on, we get yet another signal, a perfect signal that we get an exit signal for at 1.1%. So in one day on the FAS, the triple leverage ETF, it's over a 5% return on 3 trades, and our maximum risk on any one of these trades, based on where we like to set our stops, was just slightly over 0.5%. So we're trading at this really phenomenal reward to risk ratio where we're averaging, in summer, which, oh my God, if this had been October or November, these trades would have been popping off anywhere from 2 to 5% return. But in summer, we're still able to get 5% out of 3 trades for the day. So we're trading at about that 3-to-1 reward to risk. And we know during summer that our profit expectations are going to be a little less than normal. And of course, things can change over the weekend. So we come out to the next day. And again, we're always going long something. And we get a long signal on the FAZ, which is the inverse ETF. And kind of comes up, we stay with it. We actually get stopped out at break even or just a slight profit, and then we get a second long signal for the FAZ, so a second short signal. So the first trade kind of went out, came out break even, or actually by our stop is up into profit here. Came back down, stopped out, get back in long on the FAZ, and this busts up, and makes a pretty good move. We get an exit signal up here. And, I'll just scroll through the two charts. I do want to look at one thing that I talked about, FOMC day. We don't like to trade FOMC day. But the day after FOMC day, we get a really nice setup again on the FAZ to go short. So we're short the market. We're long the FAZ. You can do this in an IRA. And it kind of hits a trailing stop up here. And then again, we get another signal that just doesn't go anywhere late in the day. Scrolling through, I'm going to try to go through these quickly. Over the course of a 2-week period with one non-trading day, I calculated on the FAZ, FAS, and we had just a bunch of little winners in a row, and then we had a couple of losers. But I do want to look at one setup in particular, and something that I think is a good lesson no matter what you're trading. But it ended up netting through today. I think I marked up today as well. Today was weird. There was because we kept getting reversal signals, and then this is kind of how I marked my chart up through the day. Yesterday was bad. There were a couple of losers, but they're all pretty small, like 0.75% loser. But we kept getting reversal signals, and then you realize you've fallen into price compression. Once we realize we're falling into price compression and not a trend anymore, then we'll stop taking our signals. But and we have one of our training videos on that for our clients. But it's just kind of a good thing if you're trying to trade with the trend. Once you fall into that price compression, you no longer have a valid trend to trade with. So no matter what you're trading, even though your indicators may give you a signal for a particular trade type, you're going to get out of it. But during this, or you're going to stay out of it, and that's kind of what we did. So we had a couple of small winners today, and then we realized we're falling into this price compression. And I took the afternoon off and actually took a short nap because it was so hot and because we're doing this webinar this evening. But so over the course of a 2-week period on one triple leverage pair, it returned slightly over 10%. That was in 9 trading days. It was 15 trades, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 winners and 4 losers, trading at well over 2-to-1 ratio. And you do about a 10.5% return in 9 trading days in an IRA because of the triple leverage, and that's just on one trading pair. So you can pick up, say, oil as well, the UCO and SCO, which is double leverage. There is no triple for it that trades enough volume to trade, but they act like triples are actually quadruples because oil moves so well. In the TNA, TZA, if you're monitoring 3 markets, in a 2-week period, you can do 30%, 60% in a month. And so that gives you an idea of how, I had this great email from this client that was just stoked about the month he had, and I was so happy for him. Obviously it hadn't been as good the last few weeks. We're kind of in the doldrums. So it's a little less profit expectation. We're lowering our profit expectations, but we're also using tighter stops during summer trading, and the last half of August will just be terrible, and we know that, and usually the first week of September. But the potential is there to do really well, and you can see why that graphic I showed earlier, realistically, you can look at this, and over the course of a year, you can do a 500% return on an account. So the last thing I want to look at is something that I preach, that I do in futures, which is because volume is low right now, indicators have a tendency to overreact. And our indicator settings are pretty active. They're pretty lively. And this is a 5-minute time frame on a triple leveraged ETF. And because volume is so low, things are just turning a little more quickly than they should or than they would normally in the summer trading. And so you end up with kind of a goofy setup here. What we're looking for is lower low in our stochastic at its settings. We have other indicators that we're watching, and they need to confirm and do their thing. We don't want, there's an indicator that I don't have on here that we don't want the candle to close too close to it when the stochastic hooks, and it invalidated this setup here, and you can see in the stochastic here. And then we come down and we get another weird setup, and it's like I look at this and I'm kind of scratching my head, and we talk about this in our trading course. I'm kind of confused. Is this still a setup, or was this a valid price pivot? And so a good trick during summer, and I know people who try to go faster and they say, okay, I'm going to a faster time frame to make up for the low volume. Well, that doesn't work because it just gets choppier and noisier because technical indicators have a tendency, the lower the volume, the more they're going to overreact to a movement in price. So what you can do is actually go to a longer time frame. And by going to a longer time frame, here we see the same setup, and it's very clearly defining, well, we had a big breakout to the upside, we retraced to an area that I expect a key price pivot, and then I know that I can jump in and take my trade setup when if I'm only looking at the 5-minute time frame, it kind of was invalidated, or maybe I have to ignore this. I'm a little confused. Let me clear that up by going out to a longer time frame. And not a lot longer, but slightly longer, and I like going out to an 8-minute, and you can see in the 8-minute it very clearly defined this same move within this trend. And then so we can take this trade here, kind of off a combination of the 5 and 8-minute trade. We get out, we get an exit signal here a little too soon, but I'm always like, in summer, I'd rather get out too soon than too late because it can turn quickly on relatively low volume and still pick up about 1.2% on this trade. So even in summer, because of the triple leverage, what wasn't that big of a move in the financial sector actually ended up being a pretty decent little trade. And again, if this is October or November or March or April, this move is going to be more like 3% or 4% in something like the FAS, triple leverage financials, because of the leverage. In summer, our profit expectations are shortened up a bit. So anyway, that's kind of a look at what we how we're using the ETF market. And as I said at the beginning, it doesn't really matter what methodology you're using. Ours isn't right for everybody. But it does give you a good look at how you can pick and choose the leverage based on the time frame you're trading, whether you're intraday, short-term swing, or longer-term swing trading, to choose your leverage. And that it can really have a dramatic impact on your portfolio, and especially on an IRA, because you can go short, so you can go long and short via the inverse ETF. So you're always going long something in your IRA. You can actually get a really great return just choosing a few pairs that maintain consistent liquidity, consistent volume, really great price movement that has a lot of intraday range and isn't all in gaps. And at the end of the year, you can end up having a really phenomenal return on your account, and then you start compounding that and adding on. One thing to be aware of is the margin restrictions are much more strict on triple leveraged ETFs than they are on stocks. So they're not going to give you 100% margin. I think most, I'm with Ameritrade, I'm trying to remember, some of the triple leveraged ETFs, they won't give you any margin on. I think it's 35% on most doubles and triples. So it's lower margin that they're gonna allow because of the leverage. So I personally don't trade on margin. I just trade based on the cash in my account. So if you have any questions, feel free to shoot me an email. We're always glad to talk about trading. Brad Powell at rightangletrading.com. Or if you want to touch base with Betty, she's actually on vacation this week, but she'll be back next week. The founder of Right Angle Trading, she's a fantastic trader, really one of the first people that I ever saw to embrace the leveraged ETFs and really start actively trading them. You can email her as well on our website, www.rightangletrading.com. We're going to have some really nice specials on our trading products coming up at the end of summer, some very significant discounts and kind of packages to put together. Be thrilled to have you come learn what we're doing. I've probably taken 15 or 20 different trading courses over the years. I attend webinars all the time. As I said, I do this because I don't want to be alone in front of my computer all day. And I love hearing and seeing what other people are doing and kind of incorporate that into my own trading. I think that's how we all progress as traders and constantly evolve as traders, is by learning as much as we can about what are other people doing, what are other people looking at. If anybody has any questions, I'll hang out for a few minutes, for 10 more minutes, and we can do a little, be happy to answer any questions to the best of my ability regarding the general ETF market or what we're doing. And want to thank everybody for coming. Please stay cool. It seems like the whole country's in this heat wave. I know there's some people here from out of the country. Hopefully it's cooler where you are. And then I'm going to go watch the Olympics tonight. But thanks for coming and appreciate it. And like I said, I think coming up starting this weekend, we're going to have some really nice packages and discounts on our stuff. So I appreciate you coming. And if you have any questions, just put it in general chat because that's all I can seem to see on my screen here. Great. I think that's it then. I think we are done. Thank you everybody for coming. And like I said, email me if you have any questions. Thank you very much.